Hello once again. I'm pleased to share that our channel have now passed 500 subscribers, and this is the first milestone achieved for us since starting this YouTube channel. We'd like to thank our supporters, and we hope to continue delivering great content to you, be it investing masterclasses or just analyzing the latest breaking news in the markets so you don't have to. With this, I'm pleased to share that we have another upcoming live webinar on the 13th of May at 7:30 p.m. in Zoom, of which I will be conducting a masterclass for those of you who want to learn about investing in REITs. I will share with you the GATE framework and how I use this framework to successfully screen top quality REITs. So, for those of you who are thinking about investing in REITs for passive income, you can start registering your interest in the link on the video description section below. Take this opportunity to interact with me live and with the community by asking me questions and also share your thoughts on the topic. Hello everyone, welcome back to STA Club, the club for stock trading and analysis. This channel is dedicated to providing you with high quality tutorials, guides and insights that demystify the world of trading. Join us as we will share more trading secrets and valuable insights. To stay updated and to be the first to access these valuable resources, hit the subscribe button now. By subscribing, you're opening the door to a world of trading and maximizing your potential for success. Before we dive in, here's a quick disclaimer. The information in this video is for educational purposes only. It's not a call to buy or sell. Okay, let's now talk about today's video. In my last webinar on the 1st of April, I compared investing in a Singapore condominium versus investing in an S-REIT. I asked the question, which is a better investment, condo or S-REIT? To answer the question, I spent time sharing valuable data that I gathered and compared the price appreciation and yields of both asset classes. During the Q&A session, I received many questions and sharings from the community asking me about the potential growth of the Singapore REIT market in the next 1 to 2 years and what type of REIT to buy in Singapore. If you're keen to find out more, do join me in my next upcoming webinar in May. You can start registering your interest in the link on the video description section below. The Singapore property market has earned its gold mine reputation not through explosive volatile gains, but through a rare combination of extreme stability, scarcity, and strategic governance. In a global climate of geopolitical tension, Singapore is viewed as the Switzerland of Asia. With a total land area of roughly 735 square kilometers in Singapore, land is scarce. Singapore's population in year 2000 was approximately 4 million, and today, the population has grown to around 6 million due to an influx of foreign talent taking up residency. Analysts expect the Singapore population to grow to 7 million by 2030. Because of land scarcity and a growing population, the demand for housing could continue to be strong, driving up property and rental prices. Let us now look at the data for residential home prices, consisting of transactions for new sale, sub-sale, and resale, private and public apartments from 2021 to 2026 in Singapore. You will notice that both prices and transactions have climbed since 2021 and made a record 57,000 units sold in 2025. This was a 3% year-on-year growth over the past 5 years. Average prices in 2025 alone grew 17% year-on-year, making 2025 a very bullish year for the residential property market. You can see that in the first quarter of 2026, prices indicate a decline of 7%. However, this does not reflect a true view, as it is typical that transactions are usually slow during the start of the year. If we look instead at the monthly chart on the bottom right, from this data gathered, you're able to see that the various regulations such as the ABSD or the additional buyer stamp duty implemented by the government did not actually dampen demand. Instead, regulations have helped smoothen the demand and supply gap, preventing potential bubbles. Let us dive deeper and take a look at the non-landed private property growth rates by regions. CCR here represents the core central region like Orchard, while RCR represents the rest of the central region, also known as City Fringe Estates. OCR represents the outside central region, which are the regular heartland estates in Singapore, further away from the central region. Here, I found out that the annualized returns for each of the three regions, CCR, RCR, and OCR, were 3.73%, 6.73%, and 6.81% respectively. Clearly, we see stronger growth in private property prices in the heartlands compared to those in the city centre. Do note that these are gross returns and do not include any costs associated with these properties, such as interest payments, taxes, and property maintenance. Let us now look at the average rental yields for non-landed private properties in Singapore. The rental yields for the CCR region range from 2.5 to 3.5%, while the RCR region range from 3.5 to 4%, and the OCR region is the highest at 4 to 6%. But do note that these are gross rental yields and also do not include fees like agent fees to rent out your units and tax on rental income. So, what are the typical costs of managing an investment property in Singapore? They are the upfront ABSD or additional buyer stamp duty at 20% on the total value of the property for a second investment property, BSD or buyer stamp duty at 4% on the total value of the investment property. The stamp duty rates here assume that you are Singaporean. However, higher duties imply if you are a foreign investor. You will also need to include lawyers' fees that range typically from $2.5 to $3,000. Apart from the upfront cost, we also have to include incurring expenses of owning the property, such as monthly property maintenance fees of $200 to $600 per month, yearly progressive property tax at 12% to 36% of the property's annual value for non-occupiers, yearly progressive income tax from rentals of 0 to 24%, agents' fees equivalent of at least 1 month rental each time a rent expires, and monthly interest costs to service the property loan. There is also a hassle of managing different tenant profiles. If you're lucky and you get good tenants, then the managing should be minimal. If you get a tenant from hell, then you may find yourself spending lots of time managing them. How about investing in Singapore REITs? Is this a better choice to get into the property investment market in Singapore compared to buying an investment property? Let's find out what the average returns on Singapore REITs are. Let's first define what is a REIT. A REIT, or Real Estate Investment Trust, is a company that owns, operates, or finances income-producing real estate across various sectors, allowing individual investors to buy shares in commercial property portfolios. REITs trade on stock exchanges, providing liquidity, professional management, and high dividends, usually by distributing at least 90% of taxable income to shareholders. REITs in Singapore are considered an accessible alternative to brick-and-mortar real estate because they drastically lower the barrier of entry, offering lower capital requirements, higher liquidity, and passive management. While buying a physical property in Singapore can cost hundreds of thousands of dollars in down payments, REITs allow investors to gain exposure to professional property portfolios for just a few $100s. Investors for REITs do not have to pay taxes and ongoing fees. Therefore, what you earn is what you keep. Let me now introduce you to the Lion Global Philip S-REIT Index ETF. This ETF tracks the performance of the largest and most liquid real estate investment trusts listed on the Singapore Stock Exchange. We can see that the overall market for the S-REITs have declined from its peak since 2021, resulting in a total negative return of 24% to date, or a 5-year annualized return of minus 5%. The poor performance of the Lion Global Philip S-REIT Index ETF since 2021 is primarily due to a hostile macroeconomic environment characterized by rapidly rising interest rates, which has increased borrowing costs and compressed valuation spreads for Singapore REITs. The REIT market in Singapore as a whole has suffered from declining property valuations due to higher capitalization rates associated with rising interest rates. However, dividend yields remain attractive at 5%. By comparing both the capital appreciation and rental yield potential of both asset classes, what would you choose? Buy an investment condo or buy a REIT? There is actually no right or wrong answer for selecting either paths, as long as both paths lead to Rome eventually. Both has its risks, and the key here is understanding which path suits you more at your current stage of life. Both paths need a good understanding of its prospective markets before investing. A way to do this is to develop a system or framework that is proven to work time and time again. Once you have done your homework well, you just need to wait for an opportunity to buy at the right price, and you should do well over time, whichever path you choose. For me, I still prefer REIT investing, as it is less hassle to manage. To invest in the right REIT, I use a framework that I have developed to identify quality REITs selling at fair values. And this is called the GATE framework. If you want to find out more about the GATE framework, do sign up for my next webinar in the description link below. I hope you have learned something about Singapore properties as an investment asset class in this video. For more information on how you can optimize your portfolio and would like to seek advice on your current investment portfolio, speak to us by replying to the WhatsApp link in the comment section, and our team can provide a personal touch and talk to you about your investment plans. See you in my next video. Goodbye.